The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with me this evening. And it's good morning to some of our friends in Australia. We've got daylight savings, and oh, good. Hello, Mickey. Good to have you with us, old fella. You're going to love this. And we've got this wonderful daylight saving, which is such a great thing. But here we are in the sunshine capital and the tourist hub of Australia, and we don't have it. Apparently, it upsets the cows and makes the curtains fade. They seem to be the best arguments put forward against it, but politically, it's a hot potato. The people on the coast in the resort areas love it. The farmers inland don't. So they're the issues. But so that'll be a good morning to Queensland, New South Wales, and Victoria, and good afternoon to Adelaide and points west. Anyway, grand to have everyone with us today. Let's see who we've got. I see. Here we are. Good to have so many people with it. Albert, of course, he's a tutorial guy. Andrew, Bob. Bob was going to do a tutorial. I don't know if he ever has. I don't quite remember. Colin, good to have you with us, of course. Daryl, over in Mossman, may not be in Mossman anymore. He's done a tutorial in Waikiki, what's it called? The island. I know who will know. Jeez, I've been out of New Zealand too long, haven't I? Here we are. George, yes, good to have you with us, mate. Gig, of course, over in North Carolina. Hank, down in the Hunter Valley, wonderful to have you with us. Greg Palladini, the vastly superior experienced trader and wealth fund manager over in California, who's been kind enough. He's doing his second tutorial right now, been kind enough to share some of his findings with you guys on forum, which is great. Hank down the Hunter Valley, of course. Beck, great to have you with us, of course. John down in the Coffs Harbour. Good to have you with us, John. A new John, this would be John P., who was interested in doing a tutorial, but I haven't heard back from you, John. He's a great mate of Greg Palladini, so he might be doing a tutorial. Mark, of course, is a tutorial guy. Good to have him with us. This is the guy, very, very good trader, and he's been trying for years and years. He's done his Daniel Code tutorial, and he's been trying for years to take up trading full time, but he's such a good manager. He thinks he's retired, but he keeps getting offered these new jobs and can't say no. Mickey D, of course, who's a serious thinker about markets. You're going to find this particularly interesting, Mick. There's some new and interesting stuff for you. Michael M, the Chicago dentist, who's a super trader, done a Daniel Code tutorial, as is Murph. Wouldn't be a party without Murph. Milton, glad to have you with us, of course. And Peter Mack. Now, Peter Mack, I kept telling you, is our famous short-term trader, but it's not him. He's done a tutorial. This is a different Peter Mack, who wrote to me to say, I'm not that Peter Mack. So thank you for writing to me, Peter, and I hope I've responded to you. Phil, good to have you with us, of course. Rolf down in Melbourne. Yeah, good to have you with us, Rolf. He's a long-time Daniel Code member, and Trevor, and many others still coming in. But let's get moving. We have a lot to do today and a lot to talk about. So let's go. Here we are. See if we can get this slide to change. Yes, we have success. I've got a new computer, folks, and Waiheke, Daryl, of course it was. And I saw that Rob H. from New Zealand's with us as well. Waiheke Island. Absolutely beautiful, folks. If you ever get a chance to go to New Zealand, don't forget to go to Waiheke Island. You go over a little ferry. It's a sort of a 25, 30-minute ferry trip, boat trip, very small ferries, from Auckland. Wonderful, beautiful place. about as close to paradise as you're going to find, I think. So anyway, let's have a look at the priorities of trading here. And these ones are pretty obvious, but the big deal that I've been emphasizing recently a bit to you is market selection. And market selection is vital. We have had wonderful, wonderful volatility of late. Just the last week, it's sort of all got a little bit stagnant. But the idea of your market volatility is to try and pick markets that are not consolidating. Consolidating markets are the death of traders. So however many markets you're interested in, you should be reviewing a few more on the weekends, so you are aware of the markets that have got some good up and down movement. Doesn't matter which way they're going, as long as they're going, and that's the view of traders, of course. Okay, here we are. So have a look at this, folks. We're going to talk more about equities later on, but this is the S&P, and basically what it's done this week is nothing, like nothing. I mean, have a look at the last, the early days this week. The big key reversal bar at the bottom, zero variance. The blue line was at 4260.75. The low of that bar, 4260.75. I mean, markets love these Daniel code numbers. They're like magnets to markets. They just have to go there, and they do. And have a look at that. There's the key reversal bar. Then 3 inside bars, big range bars, all of them. And finally, it's popped up today. We're going to talk a lot more about equities because they're at a very, very crucial stage right now. But I wanted you to start thinking about that as we move along. So I'm going to talk to you about a different aspect of trading time today, give you some new ideas and tease your brain a little bit, because I want you to start thinking about the possibilities of trading time, whereas we certainly know the probabilities. We've been trading time, or I have, and tutorial people have at least for 2 or 3 years now, and it's absolutely wonderful. But you do need to know it. So this is, I'm going to show you a very different part, a very different way of trading time that perhaps you haven't thought of yet. And people like Greg and Mick D, I know they're seriously heavy thinkers, and they're going to think about it and start coming up with some new ideas. So let's, for people who haven't been with us before, we have quite a good criteria of new people. So for those of you who have seen this before, I apologize. But for the new people, this is how long-term forecasting works. This is a chart of the S&P index, and this is what happened at the 2007 high and the 2009 low. And you can see that the 59 cycle line, it's lost the first word. It hasn't shrunk itself enough to show you the comment, but that is 59 periods of 6 daily bars. Each bar on these time charts encompasses 6 trading days, and the 59 period, what we had on the count, you can see from the start of the blue line on the left of your screen as you look at it, is we had closing high to closing high on the first hop. So what does that mean? Well, on the first hop means that that's the first cycle of 59. There'll be other cycles of 59 all over the charts, but that's the dominant cycle that's come to life in this part of the chart, and we had a perfect 59 closing high to closing high. So be careful with these time cycles. There are a number of anchor points which I'm going to talk to you about today, but generally the market doesn't like to be obvious. So a cycle that ran from the swing high to the swing high, which would be the next bar, is too obvious. Now, It doesn't matter for these purposes because these time cycles are valid to plus or minus one period. And that's because it's valid to start the count from either a bar high-low or a closing high-low. And you'll see the different parts of that anchor as we move along. So on this particular chart, we had that perfect 59 cycle. This is the S&P index, incidentally. You can see the dollar sign before it tells us that in trade navigator language, that's the S&P index. You didn't get this pattern on the futures. Now, you can get absolutely valid time cycles on futures. We see them all the time, but it's a little bit more authoritative if you get them on the index. Sometimes you get them on both. We didn't in this particular occasion. So there was our first 59 cycle. We saw that hit perfectly. So once that's happened, you look to see if it repeats. You're looking for a known time cycle that's repeating. And this is what happened. Down it went from the high in October 2007 all the way down to the March 2009 low. And there was the 59 again. This time you had a closing high to closing high on the first top was what we had before. And what we've got here is 59 lots of 6-day bars, high to low, closing high to low in this case. You can see where this cycle started was actually the closing high of that swing. So that's the simplest way to look for time cycles. The more you do of this work, folks, the more you'll know, the more you'll see, and you'll get interested in all sorts of aspects of it. So this was at the 2009 low. We actually had targets at 666, and I've forgotten what the decimal points were, but not much. And that was pretty fantastic. And I happened to be running a tutorial in Taupo, New Zealand at the time where I was living. And we do fortunately have some people who were there or friends who were there who are still members and happy to say, yes, I remember that in detail. It was pretty fantastic, I can tell you, because the doom and gloom in the run down, if you didn't live through it or you've forgotten about it, boy, I mean, they were jumping out of windows. It was getting very, very dramatic. So this is what happened. So a moonshot, and we've only got the chart up to 2016, and of course it's gone a whole lot further than that. So that's the power of these major cycles. Now, we don't use the major cycles for actual trading. The risk on entry from using any of these types of charts is far too big because every single bar, of course, encompasses 6 daily bars. But I'll teach you how to handle that and everything else as well. So here we are, the same thing, looking for a cycle and seeing it repeat. So this is the mini Dow. This is actually the futures contract to show you how you can get cycles on the futures contract as well as the indices. So the first cycle here we had 63 cycles swing high to closing low. It's 1 bar earlier, so we've got a variance of 1 bar against the perfect time, which would have been the next bar. Now, why we say the other reason we can have these sort of 1 bar variances is it just depends what day the cycle fell on, what day of the week. And if the cycle had come 1 or 2 days later, that would also have been the swing low as well as the closing low. So you can see how that happens with once we put on a 6-bar cycle, we've got to contend with holidays. We've got to contend with market holidays, public holidays, which are market holidays as well, of course. But that's why I mean, when you say they're incredibly accurate, when I say they're incredibly accurate given the times that you're talking about. I mean, this is a cycle that's run from September 2018 to March 2020. And it's got a variance of 1 bar. So think about that. So as we move on from that, once we've got that cycle already, we can look for it to repeat. In this case, it's closing low to closing high, and it's still got that variance of 1 period. And that's the allowable variance for time cycles, plus or minus one period, regardless of what the period of the chart is. And we also use 12-day charts, 24-day charts, and occasionally I know Frank DB, who was a student of mine in New Zealand in 2011, and has now become the guru of major time cycles. He will sometimes use a 48-day chart. So you can see these cycles. It's enormous fun to be aware of them. As I say, you can't trade them, but it's nice to at least be aware that your bias is the right way if you have bias. And I always say don't have any bias, but the reality is most people do. Okay, so these are the anchors. What are the valid anchor points for time cycles? For those of you who want to start looking at these and learning about them. So swing highs and swing lows are pretty self-explanatory. Closing highs and closing lows are too. You might not be familiar, though, with true highs and true lows, and they're terribly, terribly important. And the true highs and true lows get disruptive when they occur with gaps, and that's what causes the variance from true highs and true lows with chart highs and chart lows. And basically the rule is if you've got a gap, if the chart low is greater than, if the chart low, there we are, is greater than the previous day's close, then the true low is the previous day's close, and the vice versa for the other side of the equation. So you can also start from the low before the low, which is where the fourth seal angles start, and you can start from the high after the high and the low after the low to start your count. They're the valid counting points. The high before the high and the low before the low, that's where we start our fourth seal angles, which you may or may not have seen. But if you stay with us long enough, you'll certainly see them. And we do not use those points for counting time. There's all sorts of technical reasons for that, which I won't bore you with. So let's move on. Once we get down to talking about trading daily bars, which is really our bread and butter, you've got to define what a daily bar is. And most people don't think this way, but if you think about what physically is a day, well, if you stand in a known spot on the earth, and say you're standing there at 4 o'clock in the afternoon, and you go through the evening and then the night, and it's dark and it comes light again. When it gets back to 4 p.m. again, that will be one rotation of the Earth, because what actually causes day and night, pretty obviously, is the Earth's rotation around its own axis. And every time the Earth turns, it's actually turned through 360 degrees. And one rotation equals 360 degrees, and that's a valid Daniel Code time cycle. So think about that, because you'll find it very interesting when you see it. But I haven't talked to you about this before, so I know that a lot of you are deep thinkers, but I'm not sure you've ever thought of looking at charts that are based on degrees as a percentage of a daily time cycle. Right. So be radical and think for yourself. There's literally, apart from the Daniel Code, as far as I know, there's nothing about trading time that's out there in the public domain. And the odd stuff that is pretty fruity. It doesn't gel with anything I know. And I know a lot because I've been doing this for a long time. So take your basic 360-degree time cycle, which is one day, but then extend it. And remember that we've got over 45,000 Daniel Code members charts, which are the charts I create for you with the support and resistance on it, which are actually time cycles, but we use them as price cycles, and they're incredibly accurate. So take that 360-degree time cycle, now apply the basic DC ratio of ½ For those of you who've done a tutorial, you know what an half is. That's the start. That's the smallest of the large time cycles. There are other time cycles. There is not just one time cycle. We have major cycles, we have minor cycles. So the first leap of that chart is 360 degrees. You'll divide it by 14.8. You should remember that if you've done a tutorial. That's the start of the Daniel Code time cycles. That's an half. So the initial cycle is 24 degrees or 24 days. Start with that on the S&P chart and look what you get. Think about this. This is these are time cycles based on the Daniel Code ratios applied to 360. Pretty extraordinary, isn't it? Because as you look through these are time cycles you've never seen before. You'll see that at the bottom of the cycles, which starts from the closing high of that important swing, you can see we get not much at the first one. We get a day past the high on the 49. We get a 62 that just gives us the return of a 1 bar counter trend. The 76 is 1 bar past that important key reversal bar low. And right at the high, which is the closing high of the, so far, that's the closing high of what we think is the end of the bull market. But there's some question marks about that, of course. But there's the closing high, that little red inside bar. And it comes at 86 on the major cycle along the bottom. But it's in exactly the same place as the 62 cycle on the top. Now, both of these cycles I'm showing you here are identical, but they've just started from different places. The major one started from an important swing high, and the smaller one, the one on top of the two, it starts from the close of the first leap, or the first step out, which is a very unusual way to look at charts, but I can assure you I've been looking at these charts for a very long time, and it is valid. You'll often see that the same cycle shifted forward one, if you like, or shifted forward one Daniel Code applied period will show you something astonishing. And what this one shows you, we're now looking at the horizontal line with the vertical marks on the top. Excuse me. The 24 gives you the swing high in early August. The next number is 62. I'm on the wrong line. 24 on the top one. The next number there is 49, which gives you the closing low of that pullback. And 62 gives you the closing high of the whole rally from 2009. And you move on. The 76 gives you an inside bar that's effectively the closing high of the counter trend rally. And the final number, the 101, gives you the high of the counter trend rally going down. That's where around there we've been trading. And 107 gives you the final, the middle bar. This hasn't got Thursday's data on it, incidentally, folks. I start doing these at 3 or 4 o'clock in the morning, and sometimes I haven't got data for the current day. And so the top set of cycles are pretty stunning. They found an important high, an important low, the all-time high so far, the counter trend high from the first correction, the low of that, the absolute high 1 bar later. That's come from the larger cycle, and they're the ones that have given you the 101 and the 107 at the bottom. I may have confused you with that. If I have, I'm sorry. But look at this. There's that 62 line sitting in the middle of it. 62 at the all-time high, and it's also sitting there as the correction of the counter trend on the bottom time cycle. Why is that in here? We're not using normal Daniel Code ratios. We haven't even gone from high to high or low to high to low. We've just taken a mathematical function where we've applied the n half of the Daniel Code ratio or 14.8 of 360. And we've got 24 days, which to most people looks random. It's not random at all, is it? Look at those turns. Worth knowing about them? Pretty much. Yes, they are. Let's see what happens here. So this the 62.5 cycle, that actually comes from the rule of 8, which if you've done a tutorial you discovered with me, but it's incorporated in the Daniel code ratios as an occasional alternate to the DC prime, which is 59.3. Usually those two numbers are alternate, but occasionally they act as companions, and sometimes both. So the nice February-March 2020, the COVID mini crash, the shortest bear market in history, the high came at the 59 cycle, the low came at the 62 cycle. So there, that was a very, very important cycle that's dominating all of the time cycles at the moment. That's how they work. The decimal points don't matter in time cycles due to the 5-day, 6-day alternate. And what I mean by that is that for 81 years, until 1952, the New York Stock Exchange traded for 6 days each week. And don't forget, it's the New York Stock Exchange data from which we get futures contracts and futures price movement. That's why they're called a derivative. They're derived from the stock market prices. And for 81 years, that market traded for 6 days each week. In 1952, they changed it to 5 days each week. But markets have memories. You may not believe that, but I assure you it's true. So what is this dominant DC cycle of 62 doing in a 360-day cycle? Well, it's wheels within wheels. When you think about this enough, you'll see that it's very possible, happens all the time, that you'll have one or more cycles running at the same time. Sometimes they're alternates, sometimes they're companions. So even though this is a totally different cycle, this is a 360-day or 360-degree cycle, which we've taken and applied the Daniel code ratios to. This is all time, of course, is what we're talking about. It's running whilst you would know, because we've talked about it often, what was happening on the major Daniel code cycles, which, as you saw from the previous chart, they both coincided at that all-time high, which is pretty nice. Okay, so what we've done here is I've got a line here at the top saying add the standard DC cycles. What I've done is I've put another time cycle on the bottom, and this is the standard DC cycle. You're familiar with these numbers. You see them on your members charts every day. 14, 29, 44, 59, 62, 74, 89. Those are Daniel code time cycles, which are also Daniel code price cycles. And that's because time and price are the same thing. But look what happens here. If we start the standard Daniel code time cycle from the point of the first leap, at the start of the 24 on the 360-degree charts, if you understand me, 62 on the standard Daniel code cycle gives you 62 at the all-time closing high. How is that possible? I mean, there are the two cycles running inside each other. One's 360 days divided by the Daniel code ratios. The other one is 100 divided by the Daniel code ratios. And you get exactly the same vibration at 62, which is the all-time high. And as well as that, on the middle depiction of time, you get 86. Extraordinary stuff, isn't it? So you need to think about that, and you need to be able to understand it, because this is telling you how time cycles work. And if you have any part of that knowledge, you'll be ahead of everywhere else, because there's very, very little available to learn about time, and nothing that I know that actually works except the Daniel code time cycles. So let's have a look. What are the equities saying? We should still be very interested in what's happening there. Well, overbalance of time and overbalance of price is an idea that's been around for a long time. And about 30 years ago, there was a group of pretty talented young traders who spent a whole lot of time trying to create an indicator called zero balance. In other words, we know that one of the ways that you can define markets or analyze markets is looking to see if they have an overbalance in price, which this chart is showing you, or an overbalance in time. And if you combine those two, they tried to create a thing called zero balance, where the market was in perfect equilibrium. And it didn't work, but those ideas have been around for a long time, and sometimes old ideas are worth examining with a fresh eye. So what you can see here, this is the S&P E-mini contract, and you can see back in that September, October, these are 6-day charts, every bar is 6 trading days. You can see back in September, October 2020, that's not the COVID flash crash pullback, that's the previous correction. But you can see that that correction there had a mathematical value from the swing high to the swing low. And that's the largest correction we've had since the February, March 2020 COVID is real ? Flash crash. Apparently it wasn't after 23 days, but the market has its own ways, doesn't it? So we've taken that length in price from the swing high to the low of those particular swings, which I've marked there in black. And we've then taken that price and we've extended it from the swing high, the current September, October swing high in here. And you can see that as a minimum, to get equity or equality, if you like, in the pullback, it would have to go down to the first blue line, which is 41.60.5. And it hasn't done that. So you don't have an overbalance in price, which is one of the ways that this particular analysis technique would define a change of trend. Now remember, when we talk about trend, we have to specify what our length of market cycle is, because markets have a number of trends going at the same time, depending on the time period. So we can't talk about trend without defining the time period we're looking at. And here we're using 6-day bars. That's our main tool for forecasting time cycles, major turns, and we can see here that this market, which we think has made a top, hasn't confirmed it because it hasn't got anywhere near for 160. And more than that, what about trading? What about overbalance of time? So we're looking for an overbalance of price. That is a correction that's greater than the previous largest correction in the cycle that we're working with. And also, we're talking about an overbalance in time. So have a look at this. From the high, we've got, well, let's start with the one before, the setup where we are. Excuse me. From the setup bars, that's the previous largest correction since the 2020 COVID flash crash. In time, we've got 3 bars down. We've got the big outside bar, the key reversal bar at the high. Then we've got a small counter trend, and then we've got the final bar down that gives us the low. So 3 bars down was the length of that correction. Look what we've got now. We've got this tiny little key reversal bar at the top, where the market has the recent top here. So that's 1 bar down, if you call that a down bar. The next bar is 2, the next bar is 3, the next bar is 4. So you can count that as either 3 or 4 bars in time. And we've got a little inside bar rallying now. Well, the market loves doing this. The market never wants to be obvious. It's always subtle. That's the most important thing to remember about markets. If you think it's obvious, if you see something and you think that's obvious, look, the reality is you're probably wrong. So markets love being subtle, and this one's being subtle. And this is the S&P E-mini. It's telling us you may have overbalance in time, or you may not have an overbalance in time. We don't have it yet in an obvious way, but you could count this correction as 1, 2, 3, 4 bars down. So the market's going to leave us guessing about that before we can give a definitive answer about whether we have an overbalance in time, which is pretty cool, isn't it? Don't forget, when time and price are squared, a turn is almost inevitable. And I pirated that expression from the great W.D. Gann, some of you know about. This is not the way Gann used it. The reason I've helped myself to it gratuitously is because I spent 12 years doing nothing but Gann. I went to all of the tutorials and seminars and things you can think of. I was buying these supposed Gann charts for a lot of money. I had some people in London and some people in San Francisco sourcing Gann charts and, more importantly, Cepharial letters. If you don't know about Cepharial, you don't know about Gann. And there's a lot of very, very interesting stuff in Gann. There's also a lot of stuff in there that's not factually correct, but it's very, very interesting. And I don't use Gann. I did use it. I used it for 12 years, non-stop. I'm the world expert on Gann, but it is not a comprehensive or proper trading system. So I don't mean to offend anyone. If you're a Gann fan, stick with it. There's certainly lots of knowledge there. So this is not the way Gann used the expression, but I've used the expression to honor Gann, who was a great influence on me, whether he wanted to be or not, because I read so many of his books and I bought so many of his trading courses and so-called original charts. And it seems to be with anything with Gann, there's a multiplicity of options and a multiplicity of views. Anyway, let's move on from the theory of time and look at the business of making money, which is actually what we do. The purpose of trading is to make money. It's not to be right, although you might say, well, if you're right, you'll have to make money. That's not true. In fact, the Daniel Code trading program, you will see, will typically have sort of 55 to 62.5% win rate. In other words, it doesn't have a very good win rate. I can give you a program that has a 92% win rate. Problem is it doesn't make any money because it's too obvious. And why the Daniel Code is so enormously successful in the business of making money is precisely because it doesn't have an obvious or a particularly large win percent, but the average win is usually 2 times or more the average loss. So once your average win, for discussion purposes, say it's twice, the average win's twice the average loss, you only need a 25% win rate to make money. You break even at 25%. So if you're running at 55 to 62% win, you make a lot of money. And the reason it does that is because it's not obvious. And as I say, the market will only respond to something that's subtle. If it's obvious, everyone sees it, they won't make money out of it. It's just the way that's the law of markets. And it's, in my view, pretty fantastic. So what I was showing you there, I hope I remember to mention it, is our typical TO3 buy signal and our TO3 plus buy signals. And you see those every day. I post those for you at the Daniel Code website. But look how incredibly accurate they are. Look where that low is at the TO3 buy signal. The red line was at 71.82. Let me find out exactly where that was, and I'll tell you. Here we are. Just bear with me a second. Here it is. So that low, where I've got the TO3 buy signal, that low was actually 72.0. I got this right. The low is 71.82. Have a look at that red line. Now that was on this chart weeks before it got there. Weeks before. And you could see it on the Daniel Code charts whenever you went to the Daniel Code website. So that low 71.82 against the Daniel Code red line, which was 71.82, that's what we call zero variance. We allow a small variance from target, 0.1%, but even though that's tight, the market is actually more accurate than that. And you can see at the current high, where today's bar went, the high of that bar is, I need some new glasses soon, folks, 74.09. Have a look where the red line is that stopped at 74.10. One tick variance. One tick variance. Beautiful stuff, isn't it? Does this happen all the time? Yes, it does. Have a look at the Daniel Code website. You're most welcome to have a free trial if you haven't already. And just look at the members' charts. You'll knock yourself out. Take the Daniel Code numbers from the website, put them on your chart. See what happens. It is extraordinary stuff. So this is the business of making money. This here, this is TO3 and plus signals, and I've now added the continuation failure points. And I think I've got a bigger chart to show you. This one's a little bit scrunched. This is the Euro USD, and you can see from the high towards the left-hand side of the chart, the blue line sell signal. The blue line is no longer on there because as the chart's moved on, we update the part of the chart you're looking at. But that had a blue line sell signal on it, which is our strongest signal. And then as it goes down, let me see if I've got a larger version for you. Here I have a much larger version. So as it starts to move down, we had that buy, up it goes. Now, for every Daniel Code trade signal, you have an entry point, which we put on the website for you. You have the place to put your initial stop loss, which we put on the website for you. And every Daniel Code trade signal creates its own failure point. And if the market goes to that failure point, you're wrong and you need to be the other way. In other words, we had a buy signal here that moved along. I'll see if I can find that date so you can duplicate it on your own charts. Euro USD, here we are. So this chart is starting on September the 3rd, is where the blue line sell came in. So you can see that we had the buy signal on September 13. That buy signal goes up, it's up for 2 days, then it's down, and it takes out the failure point. The failure point is, for us, it's 2 ticks below the true low of the setup bar. If you want to use 1 tick, that's fine. That's not really part of the Daniel Code. It's just my preference. I went through a period when markets kept electing trades with, take the high or low out by 1 tick. It annoyed me so much I decided to use 2 ticks. Well, that's a habit that stuck with me. It's not particularly scientific, and the market can still elect your trade by 2 ticks and then reverse anyway. But that's how I do it, and I've been doing it that way for a long time. So at that failure point, which is 17,700, that's the failure point because that's the low of the setup bar that gave you the buy. If that's taken out, you're wrong and you should be short. In other words, you need to do a stop and reverse there. We see this more commonly on daily charts where you get outside bars. If you get an outside bar on the day of a new signal, you must stop and reverse. Now, that must is to an extent colloquial because we know some people haven't got the software to be able to place those orders, and you don't need to be sitting there staring at charts all day. With the Daniel Code, basically you put your orders on, go away and play golf, go to work, do whatever you want to do, go and have a swim, anything nice, and as long as you've got a way of finding out that you're still connected to the platform, everything else solves itself. So let's move on. We'll get along. We get to, here we are. This is important. This is September the 23rd. Okay. And this is a TO3 and blue line buy signal. Now the blue line, the TO3s are important. The blue lines are our strongest system, strongest part of the system. we had a TO3 and blue line buy signal on that day, which was September 23, and it was not elected. The market rallied up to go to it. That's what usually happens, and it failed. Okay? When you get a failed Daniel code signal, it tells you you're likely to get an acceleration in the existing trend. In this case, because it was a blue line signal, you would expect a major acceleration of the trend. And in fact, that's what you got. You were short all the way through here, and you got, here we are, you're short in here, not elected, you're short, you're short, you're still short, you're still short. And here's the second TO3 buy signal for the next day, not elected. Trend accelerates again. That's why you get the big bars. TO3 buy signal in here. That's fine. Carry it forward. When you get an inside buy, carry forward the last valid signal you had with the TO3 buy. Up it goes, comes down, takes out the failure point, which was the low at 156.31, so say 156.30, or one tick further if you like. And if it hits the failure point, you're wrong, and you need to stop and reverse. Very important. Okay, let's move on. That is how, by using the Daniel code trade signals, the TO3 and the TO3 plus, which are predominantly price signals, you can be in the market with those signals always. Have a look at this. This is oil, which has been roaring, and this is just a recent part of the chart from September. Wow, hasn't it been great? Have a look at a TO3 buy signal into a TO3 sell, down 2 days, back up, new buy signal, up it went. New blue line and TO3 sell. It was elected, down 2 days, comes back, takes out that failure point. You've got to be long. Well, if you didn't know that, we had a TO3 plus buy signal anyway to make sure you got it. Up it goes then. Have a look at this. TO3 and blue line sell right at this high. The blue line, which has been on the chart for, as I say, a week or more, sometimes many weeks, sometimes months, that blue line was at 79.44. Look at this market. It hit 79.48. Wow, stopped it cold. Bang. Next bar's all over. Turned its toes up and down it went. Look what happens on the pullback into today's low. Today's low was 74.96. The red line, which has been on that chart for days, if not weeks, 74.96. Zero variance. Do you get zero variance all the time? No, but you get a handful of ticks is the variance. And it's so incredibly accurate. It's what makes the Daniel code different to everything else. And to prove that, if you are a skeptic, as you should be, go and have a look at the chart archives on the Daniel code website. They're free. And you will see that we have over 45,000 charts there that I've done all by hand over the years since late 2008. You'd be hard put to find a market that's turned anywhere except at the Daniel code numbers. But have a look at this chart. Have a look at its first run up, $1,420. The final run up here that we've got on the chart at the moment, $1,480. The in-between trade between those two, $2,760, say $2,800, about twice. So we've got two runs that are almost exactly equal, $60 difference, and we've got another one that's pretty much, well, it's within $40 of saying it's twice the length of those first and third lengths. I'm not for a moment talking to you about Elliott Wave, which is quite horrible, and frankly, I don't wish to be rude to Bob Prechter, who's a very, very decent guy, but I have an awful lot of people who come to me saying, I've lost a lot of money trading Elliott Wave. No. Anyway, I won't go there. Have a look at this. We see often with markets that ranges are close or very sometimes identical. Why does that happen? Because all market moves are fractals of previous moves. There is a relationship between all market moves. There is in fact a mathematical and geometric relationship. This looks amazing when you look at it this way, but we see this all the time. will see these moves on the 6S program in particular because it highlights them. It's so obvious. There's the range of the last trade. You see that range occur further down the track again and again. It's a common feature of markets, and it happens because markets create these Daniel code numbers. They don't come off out of a computer or off my head. They're created by the market itself. They are fractals of previous ranges for this particular market. And that's what creates them. And that's why they're so incredibly accurate, because it's the market themselves that's creating it. Have a look at this. This is T-bonds. Just looking at the TO3 and the TO3 plus signals. I know I talk an awful lot about time. You should also encourage me to talk more about TO3 and TO3 plus. That's what we make our money out of, trading the daily signals. Now, you make this money trading time, you might make a little bit more. You'll see here we had a TO3 plus sell. That's one of our types of sell orders at the high. Then we had a TO3 buy at the low. Up it went and got another TO3 plus at the high. Down it goes, a TO3 buy at the bottom. Up it goes. We didn't get a TO3 or plus buy at that point, but we did have a Daniel code time sell signal. So if you put all of this stuff together, you finish up being a seriously good trader. And that's how the pieces fall together. Okay, let's have a look at this. This is T-bonds over a much longer period. And you can see we had a very, very fast trend in early 2021. And in that fast trend, there were only two counter trends, and they both failed. Since then, we've had trends up, a little bit down, and then a bit up and a bit more down, but they haven't been as extreme as the move down. But have a look at the basic trend here. The counter trends have all failed. And this chart is here to show you that we expect counter trends to fail, which is why we use different risk assessment tools, and we manage our risk in different ways depending on whether we think the new signal that's going on is with or against the apparent trend. And of course, that one bar, excuse me, can change everything. What have I got here from you, actually? Some bonds, especially government bonds, calculate the day count basis as 30 of 360. Oh, that's interesting. That's, excuse me, Larry Williams stuff. He invented the concept of trading days, days of the month, days of the week, days of the year, and trading days. And he fostered the idea that these are a different form of time signals. Some of these bars have very high probabilities directionally. But for him, the way he's done it, it's all based on mechanical reality, if you like. So it's days when you're about to get a Fed announcement, or you're about to get the Fed minutes released. And those sorts of days, and there are some that are plenty that are not quite that obvious, they're a high probability of having a bit more volatility with them. But it doesn't help you from a trading point of view. Okay, so let's move on. I think we're going all right. We're pretty well there. I think I showed you this. These are the failures that you get in fast trending markets. Yes, you still get counter trends, not so many, but they fail. In slower trending markets, same thing. So if we're taking a trade, entering a new trade that is against the apparent trend, we use a different method of stop loss. So in trending markets, corrections fail at a high rate. For trades that are apparent counter trend, use tighter stops or a trailing stop or some other methodology. But your trade should be biased with and against the trend. So we get to the end of this, and if you learn how to trade daily Daniel code time signals, you solve all your problems. This is T-bonds, simply because I had that chart open, which is starting in late June 2021. Off it goes. Every turn is going to happen at one of the Daniel Code time signals. And a couple of them fail. We get 2 significant whacks of whiplash in there. But have a look at this chart and bear in mind that the maximum loss is around $550. Pretty extraordinary, isn't it? Trading time is the ultimate weapon for traders right now. It's not common. It's not well known. There's nothing about it on the website. There's nothing about it in articles. You have to learn this. If you want to do a Daniel Code tutorial, we teach you all about trading time cycles. So if you're interested in learning how I do these things, I teach you everything that you see, I'll teach you. You should have aspirations to join the elite and be a super trader. And you can do that by having a Daniel Code trading tutorial with me. If you are interested, send me an email, jneedham@thedanielcode.com, and I will send you some written material which you can consider. And if necessary, I'm happy to call you at a convenient time, have a chat about your trading, what you're expecting, and how to get you there. Okay, so if you haven't already had a free trial of the Daniel Code, please do. If it's some time since you've had a free trial, have a look. And if you previously had a free trial, the market will recognize your name and may not want to give you a free trial. We're happy for you to take a free trial every 6 months. So if you do have that problem, contact Terry at support@thedanielcode.com, and he will set you up with it. We trade Forex and futures. I had an inquiry from a gentleman the other day who's a futures trader, saying a lot of people were switching to Forex. The reality is that with the Daniel Code, which is the most accurate method of trading that I know or have ever heard of, Forex and futures trade exactly the same. I actually started off as a Forex trader, so when we started the Daniel Code website, we had a bit of an emphasis on Forex because that's what I sort of started on. And since then, of course, we've become probably a little bit dominant of the futures, but essentially they work exactly the same on the Daniel Code numbers and ratios, which tells you a lot, doesn't it? It's obviously not a different market if it would react the same way to the Daniel Code signals, and they do perfectly. Okay, so there we are. That's there for you. As I say, you're welcome to go and have a free trial if you haven't had one for a while. Lots of new stuff on the website, and do please take my disclaimer seriously. It's really, really easy to lose money trading. Let me tell you, when you know how to trade the Daniel Code, it's really, really easy to make a lot of money trading. But do not risk real money until you are absolutely confident and convince yourself that you know what you're doing. This is not something you can learn off the web. This is not something that you can learn from free posts on the web, I assure you. Plenty of people have tried that. It doesn't work. Okay, so that's us for today, folks. Hank, have a good day for you too. Let me see what we can do. Gig is left, unfortunately. We feel we're at an inflection point on the ES, but do we have an opinion? Well, I can tell you the sell-off didn't impress me. I thought with this stage I was expecting to see some violence in the selling, and we haven't seen any of that, Gig. So it's been very muted so far, and the support's been clear to see. Interestingly, the Australian SPI, the Australian Share Price Index, is usually totally dependent on the previous day's price action in the S&P. And in this such pullback as we've had, the Australian SPI has rallied twice in 2 big rally days when the S&P didn't lead that. So optimism is alive and well, and probably even more so in Australia than in the US. Here's Rolf. John, ES run until December when revisit the US debt ceiling. Rolf, this whole US debt ceiling thing, mate, it's a barney. It's a furphy. They go nuts over it. Journalists have a field day. They pump it up. This is a risk. This is not a risk. This happens every time. No change. This is just an old, worn-out record. Goes round and round and round. No member of Congress is going to acquiesce in the United States defaulting on its debts. So you can just put a line through all of that and say, if it needs lifting, it's going to be lifted. Bet on it. Okay. Good to be with you. Thank you, Murph. I'm glad you were with us today. And I'll probably be able to give you a meeting next week. I'll let you know. And Martin, have a happy Canadian Thanksgiving. I didn't even know you. Yes, I did know. Terry's told me that. Goodness me, indeed. Have a happy Thanksgiving. We don't have that down here at all. We pretty well have a couple of days at Easter, and Christmas and the New Year's a big deal down here. You guys have a few extra holidays to us. Enjoy, friends, and thank you for being with us. And bye-bye for now.